I just analyzed 10,000 failed support and resistance levels, and the exact same pattern appears in almost all of them. Based on this, I built the True Zone system, and it does exactly three things. It strips away the fake zones, it pinpoints the exact moment the stop hunt is over, and it uses volume to confirm the real move. Here's your first insight. The market doesn't trade lines, it trades zones. And inside those zones, there's a second game happening, a liquidity game where the obvious levels become hunting grounds. That perfect support you just traded, it wasn't support, it was a target. Now, by the end of this video, you're going to have three filters that tell you whether a level is worth trading or whether it's a trap. Filter 1. Zone quality. Is this level actually strong or is it noise? Filter 2. Liquidity awareness. Where are the stops hiding and has price grabbed them yet? Filter 3. Volume confirmation. Did real buyers or sellers actually show up? When all three align, you take the trade. When anyone is missing, you wait. No more getting stopped out right before the move. No more watching price go your direction without you. Let's build this piece by piece. Here's the first problem. Most levels you're drawing right now are noise. I used to mark every swing high and low on my chart. By the time I was done, it looked like a prison. Lines everywhere. And here's what I learned the hard way. When everything is a level, nothing is a level. Watch this. Here's a chart with every swing marked. Useless. I can't trade this. Too much noise. Now watch what happens when I strip it down to just the zones that actually matter. 3 levels, that's it. Clean. Tradable. Here's how you find the ones worth keeping. First thing, forget lines. Support and resistance aren't prices, they're areas. Look at this level. Price didn't bounce from one exact number. It bounced from this whole region. The wicks go here. The bodies close here. This entire zone is where buyers stepped in. When I draw my level, I'm capturing that whole area, top to bottom. Now I'm not looking for price to touch a line. I'm looking for price to enter the zone. Different game entirely. But here's the thing. Not all zones are equal. Some hold, some break immediately, and you can tell the difference before you risk a single dollar. Let me show you what I'm looking for. First, sharp reversals. When price got to this zone, what happened? It didn't chop around. It rejected hard. Fast, impulsive move away from the level. That's strength. Buyers or sellers showed up with conviction. Now compare it to this zone. Price gets there and just sits. Chops around with weak candles and no conviction. That zone is noise. Delete it. Then multiple touches. I want to see price respect the zone more than once. Touch 1, bounce. Touch 2, another bounce. Now I'm interested. A level with one touch is just a swing point. A level with multiple touches is a zone the market remembers. 3. Visual obviousness. If you have to squint to see it, the market doesn't see it either. Strong zones jump off the chart. They're obvious. And here's why that matters. If it's obvious to you, it's obvious to thousands of other traders. That consensus is what gives the level power. And finally, recency. A level from 3 years ago doesn't carry the same weight as one from last week. Recent levels are fresh in traders' minds. Recent orders are still sitting there. I weight new zones heavier than old ones. Now watch this come together. Here's a zone with all 4. Sharp reversal in the past. Multiple touches. Obvious. Recent. Price approaches and bounces hard. Here's a zone with none of them. Single touch. Old. That's a weak reversal. Price approaches and cuts through like it doesn't exist. Same chart, same time frame, One level worked, one failed. The difference wasn't luck, it was quality. One more thing before we move on. When support breaks, it becomes resistance. When resistance breaks, it becomes support. This flip is one of the highest probability setups in trading. Watch this. Price is sitting on support. Multiple bounces. Looks strong. Then this candle. Clean break below. But watch what happens next. Price comes back up and tests the old support from below. The level that was holding price up is now holding price down. All those traders who bought support are now trapped. Their break-even point is right at that level. When price gets back there, they're selling to get out. That's the flip. Broken support becomes resistance. Alright, you can now find zones that actually matter. But here's the problem. The strongest levels are exactly where you'll get stopped out the most. That sounds backwards. Let me show you why. Where does everyone put their stop when they buy support? Below the level, just under the zone. It's textbook, it's logical, and it's exactly why you keep getting stopped out. Think about this. If you know where stops are, and I know where stops are, who else knows? Everyone, including the traders with enough size to move price. Here's what that looks like on a chart. Support is here. Obvious, multiple touches. Traders buy, and their stops go below. Now look at this candle. Price spikes through support, right into all those stops, and immediately reverses. That wasn't the market breaking down. That was a stop hunt. Price needed the liquidity sitting below support to fill large orders. It grabbed those stops and reversed. Let me put you inside that losing trade, so you never forget how it feels. You see this level, you sell, stop goes 5 pips above resistance. Price rises a bit, but you're still in. It rises again, now you're sweating. Then this wick prints, your stop gets hit, and you're out with a loss. You're frustrated, but you're still watching the chart. And then price immediately reverses, drops back below resistance, and prints a massive down move. You were right. You still lost. That's the liquidity game, and you were on the wrong side of it. Here's how you flip sides. Instead of buying support and putting your stop where everyone else's is, you wait. Let price sweep the level first. Let it grab those stops. Then, only then, you look for your entry. Watch this setup. Support is here. Price breaks below, sweeps the stops. And look at this candle. Immediate reversal. Strong rejection wick. That sweep just became my entry signal. I enter here, right after the sweep confirms. My stop goes below the wick, below the liquidity grab. Tight stop, clear invalidation. And I'm trading in the same direction the big players just committed to. Same level, same zone, completely different outcome. Now you need to know where these hunts happen most. First, previous day high and low. These are obvious levels that every trader sees. Stops cluster there, and they get swept constantly. Then, round numbers. Price ending in 00 or 50. Psychological levels. Many stops hide there. And the obvious swing points. The higher high everyone sees. The double bottom that's been forming recently. The more obvious the level, the more stops, the bigger the target. Here's a real example. Previous day high is here. Price approaches. I'm not buying the breakout. I'm waiting. Watch. Price spikes through, grabs stops above, and reverses immediately. Now I'm looking for shorts. Stops are cleared, and the hunt is done. The real move can start. You're not a target anymore. You're reading the same playbook the big players use. But here's the thing. Not every sweep leads to a reversal. Some levels break for real. How do you tell the difference? The chart shows you what happened. Volume shows you if it meant anything. A bounce without volume is a suggestion. A bounce with volume is a statement. Watch this level. Price taps support and bounces. Looks good. But look at the volume on that candle. It's average. Nothing special. No significant participation. Price grinds up slowly, then rolls over and breaks the level. Now watch this one. Look at the volume. That's a spike. Above the average. That's buyers stepping in with size. That's real demand. Price doesn't just bounce, it launches. The difference between a level that holds and a level that falls is often invisible on the price chart. Volume tells you the truth. Here's how I use it. When price approaches my zone and I'm looking for a bounce, I need to see volume confirm the reaction. So price enters the zone. Then a reversal candle forms. Now I check, did volume spike? If yes, buyers showed up. The level is defending. If no, it's a weak reaction. Price might be pausing before breaking through. This filter alone has saved me from dozens of losing trades. Now flip it for breakouts. Here's a level everyone is watching. Price breaks through. Looks like a real move. But check the volume. Dead. Low participation. Nobody is committing to this break. Watch what happens. Price fakes out and snaps right back into the range. Now compare it to this. Same situation, different outcome. Price breaks the level and volume explodes. That's commitment. Traders are piling in. That breakout has legs. So when you see a low volume break, that's most likely a trap. High volume breaks, well, that are the real moves you should trade. One more layer. Volume profile shows you where the most trading happened at each price level. The thickest area where the most volume transacted. That's called the point of control. That level acts like a magnet. Price gravitates toward it. When price moves away, it tends to come back. I'm looking for confluence. When my zone lines up with a heavy volume profile area, the level is reinforced. 2 reasons to expect a reaction. Better odds. So let me put all 3 filters together on one trade. Price is approaching a zone. Check 1. Zone quality. Sharp reversals in the past. Multiple touches and recent. This is a strong level. Then price sweeps below the zone. Check 2. Liquidity. So stops just got grabbed. This means a possible hunt happened. At this point, we don't know if it's a liquidity grab or a real reversal. Then a reversal candle forms with a volume spike. We have volume confirmation, which is check number 3. Buyers stepped in with size. So all 3 filters aligned. I take the trade. Stop below the sweep wick. Target is the previous high. Watch what happens. Price runs straight up. Clean move. That's not luck. That's reading the evidence. Now, those liquidity sweeps seem easy in hindsight, but they're not. If you want to know the exact candle patterns I look for after the hunt, I made a video breaking down those entries. I'll see you there. And if you're ready to fit this into a full A to Z trading system, that's what our academy is for.